Welcome back to the Pro Ticker Podcast, everyone. It's Wednesday morning, and as always, we're here to break down the latest financial magazine headlines.
That's right.
Lots to cover today. Definitely going to be diving deep into some major stories this morning, pulling insights from sources like the Wall Street Journal, Bloomberg Market Watch, even CNBC.
Yeah, really running the gamut today.
Exactly. And our mission, as always, is to really synthesize all this information, cut through the noise, and give you a clear understanding of the big picture, the forces driving the markets right now.
That's right. Try to make sense of it all for you.
Okay, so let's dive right in. And I think a good place to start would be this whole conversation around tariffs and trade.
Yeah, seems to be a recurring theme.
It really does.
Yeah.
The Wall Street Journal has this piece titled, "Corporate America's Euphoria Over Trump's Golden Age is Giving Way to Distress."
Interesting.
And it's interesting because it kind of charts this arc, right? This initial wave of optimism after Trump's election.
Oh, yeah. I remember that everyone was so bullish on the tax cuts and deregulation. Wall Street was loving it. NASDAQ jumped. The Dow was up, thousands of points? The S&P was hitting record highs?
It really felt like a boom time.
It did for a while.
But then came the tariffs and everything seemed to kind of, shift.
Yeah, the mood definitely soured. And the Journal really highlights that they point out that the S&P 500 has actually lost $4 trillion in value. That's trillion with a T linked to these trade policy shifts.
Wow, $4 trillion. That's a staggering number.
It is, and it really underscores the impact this is having on the markets. And with this April 2nd tariff announcement looming, things could get even more volatile.
Oh, right, April 2nd, this sort of liberation day for tariffs, as the Journal puts it.
Yeah, that's what they're calling it, Liberation Day. And I can tell you, people are not feeling very liberated. They're feeling anxious. The Journal mentions that the administration is getting inundated with calls from CEOs and lobbyists, just desperate for some clarity on what these new tariffs will actually mean for them.
So that initial excitement about tax cuts and deregulation has been replaced by this real uncertainty about trade policy.
Absolutely, a complete 180, it seems.
And the uncertainty is having real consequences. The Journal notes that the Federal Reserve is now factoring these tariffs into their economic forecasts. They're expecting higher prices for consumers and a slowdown in economic growth.
Yeah, it's not good. The Fed doesn't usually weigh in on specific policies like this, so that's pretty significant.
Definitely. And then you have Trump himself acknowledging that everything could happen, even refusing to rule out a recession.
Well, that's reassuring.
Not exactly instills confidence, does it? And we're not just talking about potential tariffs here. There are already tariffs in place on goods from China, Mexico, Canada, steel, aluminum, and now they're looking at potentially adding tariffs on copper and lumber.
Yeah, that would hit the construction industry pretty hard.
Absolutely. And it's not just market sentiment either. The Journal cites a survey from the Philadelphia Fed showing a decrease in new orders for manufacturing firms.
So businesses are already getting cautious, pulling back a bit?
It seems that way. And, it's interesting. The Journal also mentions Treasury Secretary Scott Bessent and how his views on tariffs seem to be evolving.
Oh, how so?
Well, initially, he was really framing them as a negotiating tactic, a way to get better deals for the U.S. But now he's starting to talk about tariffs as a potential detox period for the U.S. economy.
Detox period. Interesting choice of words.
Right, like maybe a necessary but painful adjustment almost.
Yeah, a recalibration of sorts.
So the Journal really paints this picture of growing unease in the corporate world over these trade policies. And Bloomberg picks up on this thread as well with their article, U.S. Stock Market Liquidity Drying Up as Trade War Concerns Mount.
Oh, that's a good one.
It is, and it really focuses on how these trade war fears are impacting the actual functioning of the market itself.
Yeah, the mechanics of it all.
Exactly. And they explain how liquidity, that ability to easily buy or sell assets without causing big price swings is becoming increasingly scarce in U.S. stocks.
Yeah, basically the market's getting a bit sticky.
Exactly. And Bloomberg has the numbers to back it up. They report that liquidity in S&P 500 stock index futures has hit a 2-year low, according to Deutsche Bank. And Citigroup's liquidity index is also near a 2-year low.
Yeah, that's definitely cause for concern.
It is, especially for larger investors who are trying to move significant amounts of money. It means it's harder to get in and out of positions without potentially moving the market against yourself.
Yeah, and even small trades can have an outsized impact when liquidity is low, which can make the market feel very jumpy.
Exactly. And Bloomberg quotes a trader named Rob Friesen, who says, "It feels like you're getting run over by algo trades when volatility spikes.
Oh, yeah. Those algos can be ruthless, especially in a jittery market.
Absolutely. And the lack of liquidity also makes hedging more expensive and harder to do because it's harder to find counterparties for those trades.
And it makes it really difficult to even determine what a fair price is for an asset when trading volume is so thin.
Right? It's all interconnected. And what's really concerning is that Bloomberg reminds us that the Federal Reserve has actually raised concerns about low market liquidity in its past financial stability reports.
So this isn't just market chatter. The regulators are worried too.
Exactly. It's something they're watching very closely. And there's this Goldman Sachs study that Bloomberg cites that I think really drives home the point. It shows that 74% of recent S&P 500 returns have been driven by micro factors, things specific to individual companies, rather than macro factors like the overall economic environment.
Wow, 74%. That's huge.
It is, and it suggests that these tariffs are really shifting the focus to individual company vulnerabilities rather than broader economic trends.
It makes sense the tariffs are creating winners and losers depending on which companies and industries are most exposed.
Right, and Bloomberg gives the example of an investor named Derek Maupin who manages the Hodges Intrinsic Value Fund. He talks about how much harder it is to trade small-cap stocks in this environment because of the volatility and the lack of liquidity.
So it's not just the big players who are feeling the pinch.
Yeah, exactly. Everyone's feeling it to some extent, and while Bloomberg does say that these liquidity issues could ease if the trade war fears subside, the current climate is definitely having a real impact on market functioning.
Yeah, for sure. It's adding a whole other layer of uncertainty on top of everything else.
Absolutely. Now, speaking of uncertainty, let's shift gears and look at what's happening across the pond in the UK. CNBC has an article titled, "British Businesses Pile on the Pressure on UK Finman Reeves." And it seems like the business community there is really feeling the squeeze from some recent policy decisions.
What's going on over there?
Well, the main issue is that Finance Minister Rachel Reeves introduced a new budget back in October, and CNBC reports that businesses are really starting to feel the negative consequences.
Like what kind of consequences?
Well, the biggest complaint seems to be the increase in employment costs. The budget hiked to national insurance contributions for employers, and it also mandated a 6.7% increase in the national living wage, which kicks in this April.
Oh, wow. That's a pretty significant jump in labor costs.
It is, and CNBC gives some concrete examples of how this is hitting businesses. Kingfisher, the home improvement retailer, has already reported a negative impact. Tesco, the supermarket chain, estimates it could add up to $250 million in annual costs. J.D. Wetherspoon, the pub chain, is talking about an extra £1,500 per pub per week.
Wow, those are some serious numbers.
They are, and it's no wonder that the Confederation of British Industry is calling on Reeves to provide some kind of confidence boost to businesses.
It sounds like they're feeling pretty demoralized.
Yeah, and CNBC points out that these domestic pressures are being compounded by the global context. Things like Trump's trade wars, which are adding to the UK's existing economic sluggishness.
Right, so it's like a double whammy for them, domestic policies and global headwinds.
Exactly, and to make matters worse, CNBC reports that the Office for Budget Responsibility, the UK's fiscal watchdog, is expected to significantly downgrade its growth forecast for 2025, potentially even halving its previous estimate.
Ouch, that doesn't sound good.
It doesn't. And some major consumer-facing businesses like AB Foods, the parent company of Primark and Frasers Group, have both reported weakening consumer demand, which they directly link to the impact of the budget.
So it's hitting consumer spending as well.
It seems that way, and the British Retail Consortium is warning that these employment cost increases could add up to a whopping $5 billion in costs for retailers, which they say will likely lead to higher prices for consumers.
Yeah, that's the last thing consumers need right now with everything else going up in price.
Absolutely.
Yeah.
So while CNBC does mention that analysts at Goldman Sachs are predicting that Reeves will likely focus on cost-cutting measures rather than tax increases in her upcoming spring statement, the overall sentiment seems to be one of significant economic headwinds for British businesses.
Yeah, it doesn't sound like things are going to get easier anytime soon.
Now let's shift gears and take a look at what's happening in China. MarketWatch has an interesting piece titled, "What Investors Need to Know as China Quietly Ratchets Up Support for its Stock Market and Tech Sector."
Okay, what are they up to?
Well, it seems like Beijing is taking a more subtle approach to supporting its economy, rather than going for those big, splashy stimulus packages. They're focusing on more targeted interventions in the stock market and the tech sector.
Interesting. So what are they doing specifically?
Well, the MarketWatch article points out that the People's Bank of China, the PBOC, has reiterated its commitment to a moderately loose monetary policy stance. something they haven't emphasized this strongly since the 2008 financial crisis.
Ah, so they're signaling that they're ready to ease further if needed.
Exactly. They're keeping their options open, and they've even indicated that they're considering reducing interest rates and the reserve requirement ratio for banks at the right time.
So they have tools in their arsenal.
They do. But what's really interesting is your focus on the stock market and the tech sector. MarketWatch explains that the PBOC plans to keep using swap facilities and re-lending programs to fund stock buybacks and equity increases for listed companies.
So they're trying to prop up the stock market.
It seems that way, and a Beijing policy analyst is quoted in the article saying that market support is no longer episodic, it's becoming institutional.
Wow. So they see a stable stock market as crucial for their overall economic strategy.
It seems that way. They believe it's key for maintaining investor confidence and ultimately driving domestic consumption, which is a major priority for them.
Makes sense. They're trying to shift their economy more towards domestic demand.
Right, and on the tech front, MarketWatch explains that the PBOC is planning to enhance its reloaning policies for science and technology innovation. And they're even exploring new monetary policy tools to support technological upgrades and research and development.
So they're really trying to direct credit to those strategically important sectors.
Exactly. They see tech as the future, and they're willing to put their money where their mouth is.
It's interesting that they're focusing on these sector-specific interventions rather than broad-based stimulus.
Yeah, it's a much more targeted approach, and it shows where their priorities lie.
Definitely now shifting gears completely. Let's talk about gold.
Yeah.
MarketWatch has this really attention-grabbing headline. Gold is crushing the S&P 500. What that says about recession fears and the stock market.
Yeah, that caught my eye too, and it seems like this isn't just a blip on the radar. The ratio of the S&P 500 index's value compared to the price of gold has fallen to its lowest point since the peak of the pandemic.
So gold is really outperforming stocks.
It is, and Akash Doshi from State Street Global Advisors is quoted in the MarketWatch article saying that this reflects a growing appetite for safe haven assets like gold, combined with a potential reassessment of that earlier optimism about U.S. economic growth. The numbers are pretty striking. The S&P 500 gold ratio dropped to about 1.9 times in March, compared to 2.3 times back in December, and a peak of 2.5 times last February.
Wow, that's a significant drop.
It is, and meanwhile, the price of gold for April delivery hit a record high recently, breaking through $3,000 an ounce.
So gold is shining bright right now, literally.
It is, and according to Sentiment Trader data, the 3-month rate spread is at its widest point in over 2 years, which further underscores this shift in sentiment towards safe haven assets.
Yeah, investors are getting nervous, and they're looking for places to park their money that feel safe.
Exactly. Doshi from State Street is quoted in the article saying that traders are looking for hedges against economic and geopolitical risks, and this kind of risk aversion can often be a sign of weakening consumer confidence and challenges for businesses.
Yeah, it makes sense. When people are worried about the future, they tend to flock to gold.
Exactly, and it's not just financial factors driving this rally in gold. MarketWatch explains that there's also strong physical demand, particularly from China and emerging market central banks.
So it's a combination of factors pushing gold higher.
It is, and we're also seeing a big influx of money into gold exchange-traded funds, ETFs, as Western investors reverse a previous trend of selling off their gold holdings.
Interesting. So the smart money is moving into gold.
It seems that way, which is
Yeah.
definitely something for investors to pay attention to.
For sure. Now, speaking of things to pay attention to, MarketWatch has another article that really piqued my interest. Its title is "A Recession Brewing. These first-time homeowners will signal it first," one economist says.
That sounds ominous. What's the story there?
Well, it focuses on Mark Zandi, the chief economist at Moody's Analytics, and he believes that a spike in mortgage delinquencies among first-time home buyers with FHA-backed loans could be an early warning sign of a recession.
Interesting. Why first-time home buyers with FHA loans specifically?
Well, Zandi argues that these borrowers tend to have less financial cushion, they're more vulnerable to economic shocks, and they often represent the lower end of the credit spectrum.
So if they start struggling, it could be a sign that broader economic trouble is brewing.
Exactly, and Zandi is quoted in the article saying, if the economy is headed for trouble, it is FHA borrowers who will signal it first. And they are.
Wow, that's a pretty strong statement.
It is, and the article highlights a sharp increase in the number of these first-time homeowners missing their mortgage payments, and Zandi attributes this to mounting financial stress.
The article also mentions that while FHA loans make up less than 15% of all active mortgages, they accounted for a whopping 90% of the year-over-year increase in delinquency rates in February, according to ICE data.
Wow, 90%, that's huge.
It is. and it suggests that these borrowers are really feeling the pinch.
Yeah, for sure. And while Zandy clarifies that problems with the FHA borrowers alone won't necessarily cause a recession, he sees them as a kind of canary in the coal mine.
Right, a warning sign that something bigger might be wrong.
Exactly. And the fact that we're seeing this trend now, even while higher income borrowers are still generally doing okay, suggests that the economic divide is widening.
And the MarketWatch article also briefly mentions a rise in overall foreclosure filings in February, according to data from Adam. And an increase in foreclosures starts according to ICE data, while the latter is partly due to the end of a pause on foreclosures for VA loans. The overall picture does point to growing mortgage distress.
Yeah, it's definitely something to keep an eye on.
Absolutely. Now let's head back to Europe for a moment. Bloomberg has a report that Germany coalition negotiators agree to abolish gas storage levy.
Okay, what's the story there?
Well, it seems like the German government is trying to provide some relief from high energy costs. Bloomberg explains that the ruling coalition made up of conservatives and social democrats has agreed to abolish the gas storage levy.
What's the gas storage levy?
It's a fee that both businesses and households have been paying to help cover the cost of replenishing Germany's gas storage facilities after the energy crisis hit Europe.
Ah, makes sense. So they're trying to ease the burden on consumers and businesses.
Exactly. And Bloomberg mentions that the BDI, a major German industry lobby group, have been pushing hard for this change. They argued that the levy was putting German manufacturers at a disadvantage globally.
Yeah, high energy costs can definitely make it hard to compete.
Absolutely. And the stated aim of abolishing the levy is to lower energy bills for both companies and consumers by at least 5 cents per kilowatt hour through a combination of reduced power taxes, surcharges, and grid fees.
Wow, 5 cents. That's actually a pretty decent chunk.
It is. And while the article doesn't go into detail about how they plan to ensure that gas storage remains adequate without this levy, the move clearly signals that lowering energy costs is a top priority for the German government.
Definitely makes sense given the current economic climate.
Absolutely. Now, sticking with Europe, Bloomberg has another interesting piece titled Norway Krone Volatility Jumps as Traders Pivot to Rate Hold Bet.
Oh, interesting. What's happening with the krone?
Well, it seems like there's been a sudden shift in market expectations about whether the Norwegian central bank will cut interest rates this week. Bloomberg explains that the cost of hedging against volatility in the krone has jumped, as traders have scaled back their bets on a rate cut.
So what changed their minds?
Well, initially it seemed like a rate cut was almost a certainty. Bloomberg mentions that traders were fully pricing in a quarter-point easing after the Norges Bank governor signaled that it was likely.
But then something happened.
It did. New economic data came out showing that inflation in Norway actually accelerated in February, which really threw a wrench in those expectations.
Ah, so inflation is ticking up.
Exactly. Now, money markets are only assigning a 30% probability to a rate cut this week, a big change from just a few days ago.
Wow, that's a dramatic shift.
It is. And Bloomberg quotes an analyst named Win Thin, who says that this inflation data, combined with a recent survey showing stable corporate sentiment, has strengthened the case for the central bank to hold off on easing.
Yeah, it seems like they might be pumping the brakes a bit.
And this change in expectations has had a direct impact on the krone. Bloomberg reports that it's actually rallied, becoming one of the top performers against both the euro and the U.S. dollar.
So the crony's getting stronger.
Exactly. And it's a good illustration of how sensitive currency markets are to central bank pronouncements and economic data.
Definitely every word and every data point is scrutinized.
Now let's turn our attention back to the U.S. and a potential shakeup in the world of retirement savings. Bloomberg has an article titled Retirement Saving. Private Equity Comes for America's 401k. And it looks like private equity firms are making a serious push to get into Americans' retirement accounts.
That's interesting and potentially controversial.
It is. They're arguing that individuals are missing out on the higher returns that private equity has historically generated.
Yeah, but private equity is also a lot riskier and less liquid than traditional investments.
Exactly. That's the concern. And Bloomberg explains how the industry is actively lobbying in Washington to make it easier for companies to offer private equity as an option in their 401k plans.
So they're trying to change the rules of the game.
It seems that way. They see a huge potential market in the $12 trillion currently sitting in employer-sponsored retirement accounts.
Yeah, that's a lot of money.
It is, and only a tiny fraction of that is currently invested in alternative assets like private equity.
So they see a big opportunity.
They do, and Bloomberg quotes a former pension regulator named Charles Millard, who says, "You're not a fiduciary if you don't consider alts."
Wow, that's a pretty bold statement.
It is basically saying that if you're managing a retirement plan, you have a duty to consider alternative investments like private equity.
But there are definitely risks involved.
Absolutely. And Bloomberg highlights those risks as well. They talk about the complexity, the higher fees, the lack of liquidity, the difficulty in valuing these assets. It's not something you just jump into lightly.
And companies have a fiduciary duty to act in the best interests of their employees, so they have to be really careful about adding risky or complicated investments to their 401k plans.
Right, and Bloomberg even mentions a lawsuit filed by Intel workers over the inclusion of hedge funds and private equity in their default retirement portfolios.
Oh, wow. So this is already playing out in the courts.
It is, and it's going to be interesting to see how this all unfolds because there's a lot at stake.
Definitely something to watch for anyone who has a 401k.
Now, in other news that's raising eyebrows, the Wall Street Journal has a piece titled, Trump Family Venture Plunges Deeper into Crypto with New Stablecoin.
Oh, wow. The Trumps are getting into crypto?
They are? The Wall Street Journal explains that their company, World Liberty Financial, is launching a stablecoin called USD1.
And what's a stablecoin again?
Well, it's a type of cryptocurrency that aims to maintain a stable value, typically pegged to a traditional currency like the US dollar.
Ah, so it's supposed to be less volatile than Bitcoin and other cryptocurrencies.
Exactly. The idea is to offer the benefits of digital currencies for transactions without the wild price swings.
Interesting. And what's the Trump family's angle here?
Well, the journal mentions that President Trump's administration actually took steps to make the U.S. more welcoming to digital assets, and he even pledged to make the U.S. the undisputed Bitcoin superpower.
Wow, so maybe he sees this as a continuation of his policies.
It's possible, but this move is not without controversy. The Wall Street Journal points out that critics are concerned about potential conflicts of interest, given President Trump's past stance on stablecoin legislation and the fact that he could potentially influence regulations in the future.
Yeah, that's a fair point. It raises some ethical questions.
It does, and the journal quotes Kedrick Payne from the Campaign Legal Center, who says, "We've never seen this before, where a former president's family was so entwined in an area they're trying to regulate."
So it's uncharted territory.
It really is, and it could complicate efforts in Congress to establish clear rules for stablecoins.
Definitely adds another layer of complexity.
And just to add to the intrigue, the Wall Street Journal reports that World Liberty recently raised $550 million for its WLFI token, and Justin Sun, a prominent figure in the crypto world, is the largest investor.
Wow, so they're attracting some serious money.
They are, and the launch of USD1 has already generated buzz, with Changpeng Zhao, the head of Binance, even welcoming it publicly.
Interesting. So the crypto community is taking notice.
They are, and this whole saga just highlights the increasing intersection of politics, finance, and the crypto world.
Definitely a sign of the times.
Now, on a completely different note, MarketWatch has an article that dives into the world of encrypted messaging apps.
Okay, what's that all about?
Well, it's about the app Signal, which you might have heard of recently because it was revealed that some Trump administration officials were using it for discussions.
Oh, yeah, I remember that. And there was even a journalist accidentally included in one of those group chats.
Exactly. It was a bit of a security snafu, but it brought Signal into the spotlight. And MarketWatch explains that Signal is an open-source, end-to-end encrypted messaging app that allows for voice text and video communication.
So basically, it's designed for privacy.
Exactly. And MarketWatch emphasizes Signal's key selling point, which is that due to the encryption, conversations can only be read or heard by your intended recipients.
So your messages are scrambled, and only the person you're talking to can unscramble them.
Exactly, and that's why it's so popular with journalists, activists, and government officials who need to communicate securely.
Makes sense. They need to protect their sources and their information.
Right, and even Elon Musk has endorsed Signal in the past.
So it has some high-profile fans.
It does, and MarketWatch points out that Signal had 70 million users in 2024, and it's been downloaded over 220 million times.
So it's not just a niche app.
Not at all, and it's run by a nonprofit foundation called the Signal Technology Foundation, which relies on donations to operate.
Interesting. So they're not beholden to any corporate interests.
Right. They're all about privacy and security.
Yeah.
And the technology they developed is so highly regarded that even Google and Meta use it for their own messaging services.
Wow. So they're the gold standard for encryption.
It seems that way. And while MarketWatch does mention some potential limitations, like the security of the phone itself being a factor, and the fact that anyone can see you're using Signal if they're looking over your shoulder overall, it gets very high marks for privacy.
Makes sense. It's the best option for people who are serious about protecting their communications.
Now, to wrap things up, let's talk about something a little more lighthearted. The Wall Street Journal has an article with a surprising headline: "The surprising good news for mall owners. Forever 21's bankruptcy."
That's an unexpected twist.
It is. It seems that the demise of Forever 21 might actually be good news for the struggling mall industry.
Really? How so?
Forever 21 recently filed for bankruptcy, and they're expected to close around 350 stores across the U.S.
Yeah, I heard about that. I thought it was another sign of the retail apocalypse.
Well, it might be for Forever 21,
Yeah.
but mall owners and industry analysts are actually seeing this as an opportunity.
An opportunity. How?
Well, they believe that it will allow them to replace Forever 21 with stronger, more financially stable retailers who are willing to pay higher rents.
Ah, so they can upgrade their tenant mix.
Exactly. And the journal quotes Steve Plenge from Pacific Retail Capital Partners, who says, "We have extremely high confidence in our ability to release those spaces to tenants that will be much more productive."
So they're optimistic about finding better replacements.
They are. And the optimism seems to be particularly strong for high-end malls, which the journal reports are actually doing quite well right now with high occupancy rates and rising rents.
Interesting. I guess the luxury market is still thriving?
It seems that way. And even some second-tier malls are seeing improved leasing activity because there's just not a lot of available retail space out there.
So it's a landlord's market?
In some ways it is. And the journal even reports that Unibail-Rodamco Westfield, the company that owns the Westfield malls, has decided to stick with the U.S. market because their properties are performing so well.
Wow, that's a vote of confidence.
It is, and an analyst named Floris van Dijkum is quoted in the article saying that the mall industry is in the best shape in probably 20 years in terms of supply and demand.
Wow, 20 years. That's a long time.
It is, and it's partly because there are basically no new enclosed malls being built, so the supply is limited.
So the existing malls have more leverage.
Exactly. They can be more selective about their tenants, and they can command higher rents.
Interesting. So it's like a phoenix rising from the ashes.
In a way, it is, and the journal points out that while overall mall values are still below their peak from 2016, and there are still challenges with filling those big department store vacancies and dealing with struggling low-end malls, the prevailing sentiment seems to be that the exit of Forever 21 is a good thing in the long run.
Yeah, it allows for a reshuffling of the deck.
Exactly, and it's a reminder that even in industries that seem to be in decline, there are always opportunities for those who can adapt.
Definitely. Now that's a positive note to end on.
It is. Well, we've covered a lot of ground today, from trade wars and market liquidity to the UK economy. China's policy moves the price of gold, potential recession signals, encrypted messaging apps, and the surprising resilience of the mall industry.
Yeah, it's been a whirlwind tour of the financial landscape.
It has. But as always, it's important to stay informed about these developments because they can have a real impact on your financial well-being.
Absolutely. Knowledge is power.
Okay, everyone, we'll see you all tomorrow morning with new headlines from major financial magazines.